Just wanted to point out the information we provide today is of a general advice. If you do want some more information, please seek some professional advice.
Welcome to the 5th instalment of Retirement Living Your Way. I'm in the studio today with Greg Black and Troy Theobald. We've got some exciting topics to talk about. Look, we started early. We didn't have the microphones on, so we better get into it now.
Sounds great.
Absolutely. Well, thank you for joining us today. It's good to be here.
It is. And there's been some big news out there in the big bad world, and unfortunately it might be some bad news for some people.
I was going to say, unfortunately, it's not an exciting topic that we really wanted to touch today, but we really wanted to have a chat on some of the media reports and some of the things that's been happening in the world of investments. And for those of you that have been keeping your eyes close to the ground, you would have heard or potentially heard a few of the investment vehicles have actually fallen over the last few months, and some of the numbers are quite frightening when you actually have a look at it. I've got some of them here, and one investment vehicle which unfortunately looks like it has collapsed, and it is obviously still being investigated, some $440 million across 6,000 clients, which to us is just, we can't comprehend how these things can occur, and that's not in isolation. There's actually another 2 investments that have fallen over the last few months, with some $500-600 million in additional monies lost across another 6,000-7,000 investors. So I guess what we thought was really important to talk about today is to have a look at what's potentially gone on with some of these investments, because it is so different to the world of RFS advice. We are a very boring, consistent financial planning business.
Sure.
We're all about, what we're about.
Absolutely. Now, we're not going to mention any names today, but I think it's a really good opportunity to, like with anything in life, pull it apart and what can we learn?
Yeah. Absolutely, and I think that's probably the key that we see when you stand back and have a look at these investments that have fallen over. There are a couple of characteristics.
Yes. In
probably 2 areas. One is, how do people get access to those investments? And then secondly, what's going on with some of those investments? And Troy, you're sitting there. I know you're keen to talk. So I just thought, from your experience, because we see it day in, day out, and we read about it. What are some of the sort of things that you see? The way these investments are actually effectively sold, because that's probably the reality of it, isn't it? They are sold,
and it is. It's how do people come across it, and generally it's this social media, it's the clickbaiting. There's some little hook that's got them in there, and it's not to say that professional companies don't do marketing, all those sorts of things, but it's certainly out there with some headline, something that sounds too good to be true. And more often than not, if someone comes and sees us, they've either experienced something like this and they've just got that feeling something's a bit off. We had one in last week, a couple of, wasn't even tied up with these, but it was, they came in and sat down and, what's top of mind, what brought you here today? You sort of open with that. And they're a bit nervous, a bit everything. You seem a little on edge, nervous, everything, we don't want to be caught up with, Tesla or anything like that. And then we find out a bit later in the conversation that, their super had been in with a very large institution, and next thing you know, I don't even know, I clicked on something internet, then somebody called me and I spoke to someone, and when we dig through it, about 30% of their portfolio is in tech stocks. The exact same thing this person told a joke about, I don't want exposure to. They've now got a massive exposure to an area that they didn't even know they had.
Yes.
And it was this, they called us and said they'll fix everything and they'll move it over, and you just sort of look through, and there's certain things, even we got to that, I went, we've got a process, we've got to capture your data, client data form, surely they did that. They captured, some details. Later on we did that with, this was so much more in depth. Okay, that's starting to be a bit different. Risk profile, that should take a while. We're going to run through some questions just to work out, where you fit, from conservative and cash to higher growth. That certainly wasn't the experience they had before. And the red flag for me was their AML, because we have to sign off on an AML, any money laundering there, so ID. Now, these people had not seen this advisor or person they spoke to face over the internet, in person. Like, how do they verify your AML? You simply can't do that. So there's certain red flags off questions we can ask just on a process that just is failing on what the rules say should be followed.
Yes. All I was going to say was When you talk to all of these people, and that there's been a lot who've walked through certain scenarios, and the common thread is that they've never met these people before.
Yes.
They've talked on a telephone, or they've talked to them over the internet, or it's been an email correspondence. There might have even been a video link, but you've never sat down and met them before. Now, you buy a car, you go and spend some time with a salesman. You sell your house, you go and spend some time. You're very cautious. There's face-to-face contact. I can go to see that business at any stage, and they've got a place, and it's above board. The internet really does, and I'm sure there's some legitimate companies out there that make things difficult to identify. Am I on the right side of this? And that's where I think a little bit of advice, and decent advice too, can ensure whether you're on the right track or not.
Yeah, and that's those procedural red flags we can ask, because look, getting advice, you've sort of asked me many times, Colin, it is a clunky bit of experience, because there is lots of legislation to protect the consumer that we have to abide by. So we have to run through the client data forms, FSGs, advisor profiles, risk profiles, copying AMLs, all that. There is no shortcut.
No.
And if there is shortcuts, then if people are not following the laws, and these are laws, that's the ultimate red flag. And then constantly when I ask those questions of people,
and that's the point.
But they don't know what to ask. That's the hard part.
And the point is the AML component. You know it, you live it, you breathe it.
Yep.
We sit there and hear anti-money laundering, and we don't know it until we experience it. I recently went down to the bank. They've made a change. I can't have my staff deposit any money anymore because they need a QR code attached to an app or a card that is attached to the business. Why? They need to know who actually deposited that money.
Yeah.
Interesting, and that's anti-money laundering. And again, without coming face-to-face with it, I wouldn't have known.
No.
So I think it's fair, these types of investments that we're seeing falling over and that have fallen over, it's very much those that have really been high sales. So we're thinking cold calls, we're thinking high-pressure sales tactics, whether it's lead generation off social media. They're obviously not going through the proper investment advice process to really understand the needs of the client. So I guess the message we want to really make clear is if people are being exposed to this type of investment or these types of advisors, the red flag should be going off, because the professionals, we don't do it that way.
Yes.
We want to understand it's not a sales process, it's not high pressure, it's all about understanding what you're trying to achieve as a client, and then making sure that the investments, which is the last part, is going to actually work for what you're trying to achieve, rather than this high pressure involvement. Because you have a look at it, some of the reports that have come out, it's aggressive marketing, misleading advice. That's really the first thing that's happening. We're then going into the path of the actual underlying investments. It's all around illiquid and conflicted investments. And we'll get Troy to touch on some of those things shortly, because I think that's really something that we really want to talk about today. And then the third part, which is really it's a horrible area, and that's the whole misuse of funds, and that's fraud.
Yes, sure.
And that's a whole other can of worms, but it's pretty much a bit of a perfect storm when you've got the three of those things put together. So I guess, Troy, from our point of view, when you're having a look at, say, the underlying investments, and we know the sorts of investments that we've seen fall over, and we understand what they were investing into, what are some of the characteristics of those types of investments? Obviously, illiquidity, if you maybe touch on that.
Yeah, that's probably our biggest, our in-house or here at RFS Advice, as well as the licence there and guide up the Sunshine Coast and our licences. We lived through the GFC. We've lived through, the September 11 off the back end there of what happened, and saw what happened to underlying investments where things locked up and people simply couldn't get access to their capital. The investments wouldn't allow redemptions, people didn't get income, and people still needed to live through those periods. So,
take the technical term down to its basic form, illiquidity.
So
what does it mean?
You might have had a $1 million portfolio, there's $100,000 in a property trust or a mortgage trust, you needed money, bought a caravan, want to go on holidays. Oh, sorry, that $100,000 is locked up, you can't have it back. What do you mean I can't have it back? No, we have to put in for redemption window. Oh, and by the way, they only redeem quarterly or 6 monthly. Now, we're constantly still today having people walk in the door with that. And
so that in its basic form, you've invested in a house, and we've actually got to sell it for you to get your money.
Correct. So the issue is that. So, but when you're in a property trust, they own something like a high-rise building. So, if there's a certain amount that can cover redemption, so if only 3 investors out of 1,000 want their money back, not a problem, they can pay that. But if rumour mill, something goes around, 1,000 people go, would like our money back, or 500, we've got a problem.
Yes.
Because they can't actually process that. And the big one, if everyone would think back to, and we used to have down the road, the Centro shopping centres.
Yes.
Now think of that. Everyone knew Centro shopping centre. They were massive across the Australia there. The back end of the GFC through, when I look back at that, they simply had their borrowing due at the wrong time.
Right.
So when they had their borrowing, from my understanding and reading the cases there, could have secured their borrowing, lending spiked off the back of the GFC and went, oh, that's really dear, it'll come back in line. It didn't. Borrowing stayed high. Companies didn't want to borrow, and countries didn't want to borrow. Banks didn't want to borrow for each other. The second you can't renew your borrowing, you've got a problem. You've got to put your hand up to the regulator. You've got to put your hand up to administrator. They come in and unravels what fundamentally are great, solid investments. They've still got tenants. The tenants were paying. I'm sure the shop people down at West Burleigh were still paying their rent and all those. But purely at that corporate level, that's what, at that time, you breached those rules. They abided by the rules because they went to the regulator, and the regulator said an administrator needs to come in. Now, if you're an investor in those property funds and you suddenly want your money back, well, I don't know about you, Colin, we can't afford to go and buy what was West Burleigh Shopping Centre and Surfers and all those you can think of, because pretty much everything, when I think 20 years ago, had looked like they owned every shopping centre.
Yes, that's right.
They have to sell those assets, or someone needs to purchase them to fund out those investments. And that's just how a property fund works. So even today, there's property funds out there. The underlying investments might still be good.
Yes, sure.
They're still paying that. But our issue is for clients is when we're telling them or they're coming in, they've got these, you do understand that's not easily accessible. One lady came in, it was nearly 5 years of asking for redemptions every quarter to get her money back off something she had no idea was going to be as illiquid. And mortgage funds are the same. So a mortgage fund is backed by the fact of someone borrowing money. Now, most people can walk to a bank and borrow a fair chunk of money because banks love to lend it out.
Yes.
At a reasonable rate. But if you're in a mortgage fund, you're probably paying 2 or 3 times that. So that to me is a red flag, because that's someone who obviously couldn't go to the bank and borrow money, because why would you pay 10 or 15% if you could pay 5? You just wouldn't. So that's got to be more risky, potentially more illiquid.
Yes.
And that's probably the one we see a lot of people get caught, because they come in and go, I'm scared of shares, I want something secure, paying good income, I'm in this secure mortgage fund paying 12%. And after I pick myself off the floor and go, secure, 12%, okay, you do understand how these things work. And we sit and have that chat. So if you're getting 12, they're making money, someone's paying 15 to probably 18%. Wow, that seems like a lot to me.
Yes.
Because I know our business clients can go and get a business loan at between 5 to 7, depending on what they're doing.
Yes.
So anyone who's got to pay 18, I wouldn't want my money there.
Yes.
And when those go wrong, they go to zero, because the whole thing comes in. That administrator comes in, valuations come into question. That's where we've seen large amounts. There was a massive one on the coast, a decade or more ago. Huge headlines. That's where the issue with those, because of the underlying assets, because they're then what they call distressed assets, and no one's paying top dollar for a distressed asset.
Understand.
And a lot of clients go into these investments thinking it's a mortgage fund, it's safe, it's secure.
Correct.
That's really where there's...
The old term, safe as houses, I get it. And again, when you do break it down, if someone's paying 15% for a home loan, that means that they're not a great bet to repay that home loan. So hence, that's why they're paying those sort of levels.
Yeah, so things like that, it's just looking through the hype of, is that great, and it's a guarantee, and that's, okay, you've got to look under the headline, under the bonnet, and what's backing that investment. When I want my money back, can I get it back? And if I was on the other side, would I be the person who might even take that out? And the answer is probably no, I wouldn't. For most people would do that.
Yes. Well, I think it also raises the point around valuations as well. Because there's a lot of these investments in a lot of things like private equity, with things that aren't actually valued on a regular basis.
Yes.
So sometimes, we see it in some of the industry funds where the assets aren't valued daily. So there can be a big disconnect between what they're saying it's worth on paper to the actual value, and only because that asset hasn't been valued for quite some time. So I know we see clients come in, and whenever they mention private equity, Troy sort of lights up and
colour goes from my face.
Because it's something that we just... they're complex. They can be very, very opaque.
Yes.
And the reality is, 99% of investors don't have the risk tolerance. Would that be fair?
Yeah, and we have managers coming in, we've got a private equity fund. Oh, what's embedded? Oh, it's really complex, lots of things. Humour me with lots of things, please.
Yes, that's
and
right.
they tell you 2 or 3, okay, so out of the 500 million, you've told me where 20 million is. Could I please ask where the other 480 is? Oh, well, it's funding this, and there's just so much convoluted. And Greg and I were talking before this, preparing for this, going, well, why? Why? So we look at that because we're boring conservative, just do what we do. So why? And Greg was up. Why do people do that? And why do advisors recommend it? Because we're seeing the industry is all about it's 20, 30, 40% in unlisted, illiquid property, and I just think that's 100% the wrong way in our humble opinion. Where the clients who's got 100,000 or 10 million, they don't want to lose their money.
Yes.
They don't want it liquid. They want a decent return. I don't think they want that ridiculous risk of it could go 5 times or it could go to 0.
Yes.
And I really don't think they're having it explained to them in that.
In that sort of
simple
form, I agree.
Yeah.
So pulling it all back, we've looked at the minutiae to a point and the mechanics of it. What can the listeners do out there to protect themselves, I suppose?
Yes, there's a couple of things to look through, and the government websites do list a few things on Money Smart website on a few questions and good things to actually ask. And the simple checks, just checking history of advice firms, complaints, all those sorts of things out there is probably a handy starting point with those. Have they complied with the procedural scenario? Like it should feel a little clunky and intrusive advice. It shouldn't be, it's really easy and I just signed 3 things and clicked 3, DocuSigns and I was all done. It should be getting to know you. It
Yes.
should be personal about your situation. It should be about what you want to achieve and how you're going to get there. And then the last bit should be the product. So if the first bit is all about this wonderful solution, that's probably a little of a red flag.
And unfortunately, it does happen. Like we had a prospect in this week that came in and saw us. They saw another advisor up in Brisbane, and I said, where are you at? What are you looking to achieve, etc. They said, well, I went to this advisor and I wanted to plan about my retirement and understand, well, am I in a position to retire in 5 years' time? How will that look? What sort of income, etc., etc. So the right sort of questions.
Sure.
What came back in the advice was very much product specific. Roll your superannuation over here. Do this. We want to move your insurance to us. And when that client went back and said, well, what about my retirement strategy? What about how much will I have to live? All those sorts of questions.
It was about them.
It was about them. It was about the product. And they came in and saw one of our team and with Darko, and it was just like, oh wow, this is what financial planning should be like. So I think, and another thing I'd add to Troy's point about the sorts of things people should look for, I think follow your gut.
Yep.
I think it really should come back to nearly, if it doesn't feel right, if you don't feel like you're being heard or the answers that are coming back are just inconsistent with where you're at, I think your gut's a great place to start.
Yes.
Because most people, when you talk to them about how did you feel through the process when you thought you were gaining this advice and it didn't end up the right advice, something just wasn't right.
Yep.
But I thought, and they convinced me and they said the right thing here and they had the buzzwords there. So I think that's another thing we can never lose sight of.
Yeah, no, I agree. And that would be the most common thing, I suppose, why people come out and seek advice or a second opinion. And we've said that for
Yes,
a long
very
time on
much
the
so.
radio. If you're not comfortable, go get another opinion.
Look, it's a lot of money and it's taken you a lot of time to gather it, gain it, working your life to obtain it. It just takes a little bit more time to make sure that you're making the right next step.
Yeah, yeah. And even some of the, Greg and I are talking about why some of the advisors might recommend some strategies out there. And look, in their opinion, it's their perception might be they're going to advisor to get the highest returns and access to things they couldn't get elsewhere. I've had advisors tell me that. I'm like, well, I've got people at $10 million or more and they don't want that at all. They want to sleep at night. They want a good return. They want their money safe, secure, compounding over time. That's the style of client that would come and see us. So maybe everyone's walking in the door and asking them for the highest performing Ferrari they know in the world out there. I don't know. I don't see that myself. I don't think that's a great way to go about investing long term, trying to pick the next winner, because it's shown over history to be difficult.
That's right.
Yeah.
That's
But
right.
just on that, I wouldn't mind getting your thoughts on a buzzword that we hear a lot around it, ETFs.
Yeah.
I just think that that's an asset class or an investment that people are hearing about and they think it's all sexy.
Yeah.
Do you want to just explain to people where that works and where it can go wrong as well? Because again, similar to...
So an ETF is an exchange-traded fund. It's sort of a fancy listed version of a managed fund. So and people might know managed funds or, like your managed super, it's all in a balanced fund. It's that style of wrapper.
Yes.
And that's all it is. It's a wrapper that does that, listed on the stock exchange, so it's valued, regularly or instantaneously if people are buying and selling. But it's where that invests is the key. So it could be, there's a NASDAQ ETF. Now it just buys all the funds on the NASDAQ. So if you get up in the morning and look at the telly, what did the NASDAQ do? That's what that one will do. Mm-hmm. If that's what you're after, great. But if you're after something that's such and such as private equity investment, what does that do? You don't know. Where do you find out what it's actually doing? Just because it says private equity, what does that mean? And you need to dig deeper to see what that underlying investment's investing in. Is it investing speculative stuff that you would never touch?
Yes.
The fact it's an ETF, none of that's going to save you. It's the underlying investment, where it is and what that's doing. And I fear that, we got asked at one of the advisor things about 5 years ago, what blows up the industry, and that's what I wrote down, ETFs.
Yep.
Because it's the new wrapper, exactly that, where people, I'm in an ETF, I'll be fine. It depends what it's doing. Yeah. And that's the question I would ask the client. I've got this ETF, it's done really well, it's done 20%, great. What does it do? Or I know what it's called, but that answer is way more common than you would think. I mean, I know you're sitting there laughing. Really?
Well, I'm not, because I can actually see it. I think to myself, well, I buy Wesfarmers, I know what they do. There's a Bunnings across the road here. I can see people streaming in and out of it. I can see all the stock on the shelves, and there's bucket loads of them around the country. I know what they do.
Yeah.
But then when you're talking about ETFs, this is the investment, this is what you're buying into, this is the return. But what are they actually doing to actually gain that 20%? Yeah. That's what you're talking about.
Correct. And the investment could be good. We had a client or a prospect the other day came in, my neighbour's got all his super in this Vanguard ETF. I'm going to put all in there. And I'm like, okay, you do know that's 100% in international shares, and that's probably why it did 20%. It could do minus 50 next year. Okay.
Didn't realise that.
Yeah. So the return sounded good. Yeah. The name was good. Vanguard, biggest money manager in the world. Sure. It must be fine. It will, but it's, you get out of bed and watch that S&P 500, what's going on over there, it's going to follow that, and that moves up and down a lot, and most people don't want that.
I think the biggest issue is that you look at every company, they all have their trials and tribulations. They have their winning years and they have a not so winning year, or even a year where they haven't gone so well. And that comes down to external factors. But understanding what they do means you understanding what your money is doing.
Spot on.
Yeah. And ETFs, and personally, they are a great enabler. We use them a lot, but we'll use something like a NASDAQ ETF if a client wants exposure to the NASDAQ. Why pick Tesla, NVIDIA? Pick something that's really nichey. You can have a bit more security and have the whole indice, or you might want to cover the All Odds. You know what?
That's right.
You can cover that now for like 4 basis points with one we use. Really cheap. Why, you get out of bed, what's that going to do? Exactly. If you watch the All Odds every day, it's exactly what it's going to do. Low cost, great enabler. So used correctly, they're really helping lower costs, but just knowing what they do, that's the key.
So you've been doing this for a long time, 25 years. I know, I was being polite. How's your approach to investments changed through that journey? Because I just think, you've lived and breathed it for so long. Yeah. You mentioned the GFC before. So keen to understand how you tackled that for clients, because that was a frightening time, but also just to see how you've moved, because we've definitely see parts of the advice market where they do try and get complex. They do try and make it a little bit more sophisticated. There's the whole use of wholesale investors, which are those investors that might have income over 250 or net assets over $2.5 million. Just because someone's got that level of wealth doesn't make them wholesale or doesn't make them understand anything anymore. They might have made the money elsewhere and now they're looking to invest in a more complex area. So, Troy, from your point of view, how have you changed the way you manage the
I suppose GFC was a learning point from that structure. We sort of mentioned that Centro example before.
Yes.
So was it a Centro issue? No, it was actually a structural issue. So that's an issue with property funds. So if we have property funds, how do they get their money? They have to get borrowings. Borrowings come from a bank. If you had your debt fall due, you could have been the biggest Nelly in the country back then. That still didn't protect you. So it came down to, do I want access to anything that could be liquid or not? And if the answer is no, I would like my money back, well, all those property funds, no matter how good they are, they're out.
Yes.
They're in I won't touch bucket. Then we go back to mortgage funds, which we spoke about. So those mortgage funds as well, what are they backed by? Well, property and borrowing, same situation. So that chance of a liquidity, massive there. So, my experience back in the GFC, we had exposure pre that to property funds, mortgage funds. No one's seen any issues, decades, everything gone along. All of a sudden, the mortgage funds BDMs, which frankly were probably pretty lazy back then, all of a sudden were starting to tell me how great defaults are. And they're coming out more regularly. And I've grabbed Sarah in the office, employee number one, still there, and I went, have a look who's booked in the next 2 or 3 weeks. It's all of the mortgage funds and property funds getting out there. I went, all different companies. This is weird.
Yeah.
And then 1 or 2 have come in, and we're like, and they're starting to tell us how great defaults. This is before anything's got too bad. We'll get higher interest. Common sense says to me, people not being able to pay their bills is not a good thing. So we moved all of our clients out of the property funds, thought, wasn't that wonderful? Then realised, go to bed the next day. Oh, hang on, the mortgage funds as well. Yes. Clients out of the mortgage funds as well. All right, so it's avoiding the blow-ups.
Yes.
And from our perspective, 2 or 3 months later, a couple of property funds at issue, the whole industry within 48 hours had a problem. The next 48 hours, the mortgage funds had a problem with illiquidity. Nothing wrong with the assets. People are still paying their bills at this point. Purely couldn't pay redemption. So that's a structural issue. So we still today won't touch anything that can be illiquid.
Yes.
Because structurally that hasn't changed in the last 25 years. Yep. The structure, the wrapper, with my nerdy accounting hat on, it's the same vehicle.
Yes.
That's just how they work out there. So from our perspective, something we're not a big fan of. And each person can have their own philosophy in regards to that. But we're not anti-property, but if someone wants a property, I'd rather them go and buy their own investment property. Buy it when you want, buy it where you want, sell it when you want. Have control.
Correct.
Control your own outcome, because it's all about that control. That's once they lock up, you've got no control. And this poor lady, the underlying investment was still good. It was solid. She still got a decent return, but 5 years to get that money back is just...
Wow. And that's the bit that you don't understand going in.
And that's an investment, didn't have any issue. It's just there's only so much every quarter to pay out to an investors. And if you've got a large amount of money, well, your redemption's pretty big. So you're getting a smaller portion of that. So, yeah, we learnt those lessons, and they're a lesson you learn for life. There's lots of people that, haven't been around for quite so long. Thank you, Greg.
Well, that's
the younger ones in the office haven't seen those sorts of things, and that is the learnings that hopefully you pass on, because, we saw advice firms and practices that really believed in property funds at the time. The poor clients, so we're talking about these other things at the start. These are people who probably believed in these approaches, and this private equity is going to do all these wonderful things and massive returns, but it comes back to what do we really think the people want? And I don't think they walk in our door for the next U-Butte thing. What's the next Bitcoin, the next thing that's going to go through the roof? I don't think they're wanting their advisor to pump their life savings into that personally.
No. They're looking for a solid commitment and a solid investment and solid advice. Again, if you want to gamble, well, there's plenty of places to actually go and do that and be in control of that and let somebody else do it on your behalf.
Yeah, but to Greg's point, we go to constant things in the industry now, whether it's this wholesale and it's private equity and it's all this and it's a bigger percentage of the portfolio. And look, the big industry funds can do it because if they need to redeem $100 million, they've got plenty of other buckets and areas to get it from. When it's your whole portfolio and that's 30% of it, it means if you want a redemption, it's got to come out of the 70% of your investment.
Yes.
There is no other buckets of money. There's nothing else to sell. And if you want 100% of the money, you've got a major problem because it's just not going to happen.
Sure.
Yeah, and I think if you have a look at, I guess, the approach that we've got at RFS Advice, it's, we really want to use professional, large-scale investment managers. We want liquidity is obviously non-negotiable. We have to have that. We want something that's simple, easy for people to understand.
Yes.
I think that's really important. Diversification. So making sure we've got enough diversification to get the different types of styles, and Troy could put his accountant nerdy hat on, which he loves, and spend 4 hours talking about that. But it's really important that some of those basics that we've got, and then on the other side, or next to that, is the whole independence around governance and making sure that everything's arm's length. So using the right structures, the right people, it makes all the difference. And we don't need to try and be too creative.
Yeah.
That's the reality, because we're having the right conversations to understand what's important to the client, and that's really where it counts. And the investment piece, as Troy said, he's been doing this for a very long time and learnt from it, and we're using a very simple approach to managing the actual assets.
Nice.
I think the key message from today is if you're sitting there and you've got a portfolio and you're unsure, or maybe we've touched on a few things, whether it's the property funds, whether it's the mortgage funds or the like, look, reach out. Obviously, we're always available at RFS Advice, but if you want to speak to someone, get a second opinion.
Yeah,
I think that's really the key. And I know it's it didn't start off as a great conversation as far as people losing money.
Yes,
but it frustrates us so much, and we get so angry that there are still these schemes out there where people get sucked into. They are doing the best thing that they think they are doing, and all of a sudden, for whatever reason, it's bad, they lose their money. It's very difficult for those people to recover. So we get so angry with it. We just wanted to make sure that people understood that that's one way of things. It shouldn't happen.
Yeah.
But the reality is the right way to do it is so different, and it's so simple, and it's basic. It's not complex. We're not trying to overcreate or overcomplicate things.
Absolutely. So it's interesting to see the internet is a dangerous place, as we were talking off air, and you hear people wanting to rush you into computer-based investments and all sorts of wonderful type schemes because you clicked on a button. Take that moment to pause, think about it. There shouldn't be a rush.
No.
And ask the relevant questions. Go and get some advice from someone else.
And if the gut feel's not there,
absolutely.
Yeah. So, guys, anything that we started the conversation with some bad news, anything that you can do or you can advise for those people who have been caught up in the ones that are actually in distress at this point in time. Let's use that word.
I mean, the government websites there are designed for people to register for these types of scenarios there, so they are putting compensation schemes in place. So we're the only industry that those that don't have any issue fund the bill for those that ignore the law, because they are laws they are breaking.
Yes.
Out there, so registering for those at least gets on a list. There was some, last few years we had people come in and you don't need an advisor. I send them to a lawyer. I think that's who you need first. Just, there's schemes where you can register online, free on the government scenario there. Websites there. It should be in all the documentation. That's the other. Every website should have the complaints procedure. You go to a homepage of anyone financial services, it should have a financial services guide. It should have the complaints process, and it should have links to the government regulator on there for a complaint. Now, when these sort of key things don't happen, hey, no one took a copy of my ID. Now, they should do that face-to-face in person, because how else have they actually done it?
Yes.
When you've got procedural things that just aren't following, and these are laws, not like nice-to-dos, these are law, when they're not doing that, even before you got to the investment issue, the procedure should be a red flag of, oh, hang on, well, this doesn't sound kosher. Yeah.
Absolutely. It's always a sad affair when the internet can drag you into some terrible, terrible things.
Absolutely.
All right, guys. Well, thank you very much for your time today, and I hope that was enlightening. Reach out to the guys at RFS Advice at rfsadvice.com. They have a wonderful little newsletter. You can also connect with them at 4crb.com, and they also do a show on 4CRB every second Monday of the month.
Thank you, Colin.
Thank you.